Learning Objective 19-3, understand financial reporting rules and make basic journal entries for not-for-profit healthcare providers. And again, I don't think this is anywhere here, but you also have for-profit healthcare providers, and they're just going to use regular FASB accounting because again, those are companies, they're shareholder owned, and none of this is going to apply to them at all. They usually don't receive donations, so they're just regular FASB GAAP. Not-for-profit hospitals and healthcare organizations could include all sorts of other things too. They may include clinics, medical group practices, individual practice associations, individual practices and practitioners, emergency care facilities, labs, surgery centers, ambulatory care organizations, all with the requirement that they're not for profit. Continuing care retirement communities, health maintenance organizations, home health agencies, hospitals, nursing homes, drug, alcohol, rehab centers, and so on, provided that they're not for profit. If they're for profit, they may sometimes draw on these rules when the FASB is silent, but they're mainly going to just use regular FASB accounting. And not for profit hospitals are also going to use the various FASB rules for not-for-profit organizations. So it's kind of a combination of, and the FASB rules comes first, by the way, according to the hierarchy of GAAP. So in the hierarchy of GAAP, of course, the accounting standards codification would always come first, but a second guide is going to be this AICPA guide here, which is very helpful. Governmental hospitals are going to follow GASB. So you do have hospitals that are owned by government. It's interesting, VA hospitals are federal government, so they don't use GASB reporting. They could use federal government accounting, which is a different system entirely. But you may have, like, for example, a municipal hospital or a state-owned hospital. One thing which I've seen, I know about, are state-owned, not from personal experience, okay, but a state-owned psychological care institute. That they would all follow GASB GAAP. And again, investor-owned for-profit hospitals follow regular FASB accounting. And occasionally, sometimes it happens that the AICPA guide comes in handy because there are no rules anyplace else for what to do. So for example, a medical group practice is probably going to be a for-profit organization. It's going to be a partnership or a limited liability corporation or something like that. And so they're just going to use regular FASB GAAP. But occasionally issues are going to come up that the FASB does not talk about in the Accounting Standards Code, and therefore they can also rely on the AICPA Audit and Accounting Guide. Now, hospitals often use fund accounting, but they're not required to use fund accounting the way governmental accounting is. And they do need to keep track of without and with restrictions. See, I said in the right order now, without and with donor restrictions. Operating activities will be carried out in what's called a general fund. And then they could have a series of funds with restrictions when there's a donor restriction. So when a donor places a restriction on certain assets, those assets could be put into their own fund. My experience, they usually are. And then that's a way of keeping them separate from the general fund. So all the transactions are going to be recorded in the general fund, and that's mainly where they do business. And they call it here funds with restrictions. They also holding funds. The term that I've seen is, and I actually did a lot of work in for-profit organizations, that's not-for-profit organizations and hospitals when I had my very short-lived accounting career, and the term we always used was restricted fund. It's just a restricted fund. So this is kind of the fund structure, and even if you don't use funds accounting to record these things, you still need to keep track of this. So that's why most hospitals are going to use funds accounting. So they have 4 types of donor restrictions. You'll have your general fund, which is without, and then you have 4 types of with. You have what's called specific purpose. That would be where the money is donated to be used towards a specific purpose. You'd have time restricted, where the money cannot be used for a certain amount of time. It's usually supposed to accumulate income, and then to accumulate income, and then it can be spent. Plant replacement and expansion is for when someone donates money to be used, like for a new building or a new pavilion. That's what they call it, pavilion. They have, because a pavilion, you can raise more money for a pavilion than just a building. You know, a building is like, that's a $5 million donation. A pavilion, like that's $15 million. I'm going to donate a pavilion to the hospital. It sounds really good. I don't know what a pavilion is. Anyway, that would be plant replacement and expansion, whether it's a building or it's a pavilion. Endowment would be where you donate money to the hospital, and you see the hospital, you're not allowed to spend the money, but you can invest it and use the income. So it's called a permanent endowment, was the old term. Now it's just called an endowment. So this is not to be confused with a time restricted, which goes into the endowment fund for a certain period of time, and then it can come out. An endowment is not supposed to leave the endowment fund ever. I don't know when you would take it out of an endowment. I can't imagine it's forever. Like, if the hospital no longer ceases to exist, the money is supposed to go to the state. So let's say you have a hospital has an endowment fund, and it goes bankrupt. It's possible a court would allow them to release the money to save them from bankruptcy. But what's more likely, what could happen is that the entire hospital would go to the state, and the state would take it over, and they would be allowed to use the endowment funds. But each state usually has an office that would be responsible for that type of property. So financial statements of a not-for-profit would issue 4 basic financial statements. This is not quite right, because the general fund is also part of these financial statements. Balance sheet, income statement, or a statement of operation, because there's no income, statement of changes in net assets, and statement of cash flows. And these are kind of combined. So you really have your statement of operations, and that should feed into the statement of changes in net assets. So let's talk about each of these. The balance sheet is going to present the assets, liabilities, net assets. Receivables should be reported at anticipated realizable amount, meaning that oftentimes receivables include pledges, and you don't collect 100% of pledges. So you need to record the receivables at whatever you do expect to collect. Investments are initially recorded at cost, and then they're marked to fair market value. If they're received as a gift, then they would be recorded at fair market value at the date of the gift, and then again they would be adjusted to market value. Plant assets, recorded at cost, obviously, with accumulated depreciation. Asset whose use is limited is, for example, assets with restrictions by donors. Long-term debt is long-term debt, and net assets would be without and with restrictions. Here they said with and without. You should really say without first. Let's look at a balance sheet. Here's the balance sheet. So you can see here again, assets limited to use includes a lot of your restrictions, and then long-lived assets. So they don't do separate columns here for without and with. Rather, they just have a separate section. I think you can also do separate columns if you want, but it makes it confusing because you're showing 2 years. And then current and long-term liabilities and net assets. I have to tell you this, that it's been a long-term project of the FASB to get not-for-profit organizations' financial statements to look like companies' GAAP financial statements, and they've really come a long way. If you looked at a hospital balance sheet 20 or 30 years ago, I worked in hospital accounting, I guess it's almost 30 years ago now, and it looks completely different because you would have to post the donor restrictions in certain ways. all different kinds of restrictions and so on. And so they've really managed to clean up the balance sheet so it's much easier to look at. Statement of operations, also statement of activities. Accountants commonly call it the P&L, and this is really wrong because you don't have profit and loss in a hospital. But that's when you hear someone say P&L, when the partner calls the financial statements, the statement of operations, the P&L, and it's a not-for-profit, then you should know that they're talking about the statement of operations, the statement of activities, and I don't know, it's a separate question whether you want to correct the partner and show him how much you know, and say, it's not a statement of, it's not P&L, it's a statement of operations. Anyway, be careful. Includes revenues and expenses, gains and losses. It's a P&L, it's an income statement. You only have the general fund transactions, and you're going to report with donor restrictions separately. And what they want is an operating performance indicator of the operating activities. We'll look at that in a moment. And these are your major accounts: net patient service revenue. And usually with hospitals, they have what's called the stated rate, and then they have discounts. So when you arrive at net patient service revenue, that would be the actual charge. But you also have what's called stated rates or listed rates, and this would kind of be the retail price. So hospitals typically have a retail price, and if someone just walks in off the street and says, hey, I'd like brain surgery, they'll give you the retail price. But if you're a health insurance company or you're Medicare or Medicaid, you get a discount. And that's what we mean by contractual adjustments. So what happens is let's say Cigna, all right? Cigna, the retail price for brain surgery is $100,000. But Cigna has negotiated contractual adjustment so that the price is only $40,000. So you would have gross patient service revenue, $100,000, minus the contractual adjustment of $60 would give you net patient service revenue of $40,000. You also have what's called ancillary programs. This is other things the hospital does to make money, like the gift shop. And gift shop is not really donations. And interfund transfers that go back and forth between the funds. We'll look at that in a moment. General fund expenses would be whatever it costs you to run the hospital, obviously. And donations are going to be revenues. And let's look at one. There you go. So you can see her net patient service revenue is not the list price. That would be gross patient service revenue minus the contractual adjustments. And these are some of the other items: gifts without donor restrictions, and this is strictly for the general fund. And then you're going to see here, we're going to go into the with donor restrictions. Then here are your various expenses. It's not called income, it's called, first of all, they have excess of operating revenue. Then they have they have income investment return in excess of amounts designated for current operations. Net assets released from restrictions is going to come in here because you'll see the restricted income statement in a moment. The statement of changes in net assets presents the changes in assets without and with restrictions. See here, they did it in the right order. So, and your statement of cash flows is just going to be sort of a statement of cash flows. So the way this would look is right here. So your first section is without restrictions, and that usually goes first. So we have the excess, which was kind of income, plus these other two items, giving us our net increase of $340 without. And the assets with donor restrictions are shown here, and they list out the various different items. They have contributions to with donor restrictions, investment gains, and so on. They subtract net assets released from program use. So you can see here, equipment acquired, $225,000 would come out of net assets with donor restrictions, and it would go into net assets without donor restrictions, shown right up here. This 180 is should be someplace, here it is, 192, net assets released from restrictions for use in operations went into the regular P&L because it came out of with donor restrictions right here, 180 plus 12. And they show net assets at the beginning of the year. This is kind of a simplified format. I've seen a better format where they split them out in a more meaningful way into two columns. So any contributed assets that are restricted as to purpose or time period are going to go into assets with restrictions, and then they can come out of that once whatever that requirement has been met. So funds can have restrictions that expire. Specific purpose fund, you did whatever you needed to do. Time restricted is the amount of time the donor specified is up. So the donor says you can't spend this money for 10 years. And a contribution that's pledged is obviously going to be time restricted because you can't spend it until you get the money. And planned replacement and expansion, again, that's the building or the pavilion that you would that you've received money for. Now you also have what's called an endowment fund. And again, as I mentioned before, this would be donations, usually cash or securities, where you cannot spend the principal, but you can use the income either for specific purposes or for general purposes. So the donor may restrict the income from an endowment for, say, scholarships or something. I'm talking about universities again, colleges and universities, but they may restrict the income from an investment for, say, property, plant, equipment or something like that. But you can't spend the principal. So that would still be an endowment fund, and it would be with restrictions, obviously. Term endowment would be a period of time, and that would be not really an endowment. That would be a time-restricted fund. So the term, when you say endowment, it means a permanent endowment. Restrictions into perpetuity. Because by definition, and it's not really clear here, otherwise it's a time-restricted fund. So, and all your activities are going to take place in a general fund. Next video, I'm going to show you how the journal entries work.